Welcome back to the Financial Shepherd podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today, delivering today's podcast. I got a lot to cover. We got some new inflation news. We got the end of the year market expectations to talk about. We have 2025 expectations to talk about. As there couldn't be a better time of the year to be doing those sorts of conversations with folks after another 20+% type of year in the S&P 500, back to back 20+% type of year. So the question is, what's next? And we're going to deliver that information for the audience today. So I'm excited about that. What else are we going to get into? Anything on your mind?
Yeah, we got plenty of stuff. I mean, I'm going to take a second to just high five us for being back-to-back world champs on that, because at the beginning of this year, the Financial Shepherd podcast was the only place I could find calling for another double-digit return. Tons of doom and gloom, but you stayed the course and navigated all the clients into a really wonderful year. So,
Another hell of a great year. We're getting rewarded from that right now, not just from client appreciation, but we are now officially registered with the Securities and Exchange Commission, the SEC. So we are a RIA, Registered Investment Advisory firm here at Shepherd Wealth Management, custodying accounts for clients across 15 states through Charles Schwab's platform. And we've eclipsed that $100 million threshold to be able to register directly with the SEC. And there's a lot of perks to come along with that. So we're super excited. Wanted to thank all the clients, every single one of them, whether they joined us from day one or just joined us here yesterday. Wanted to thank all of them, because without them, that certainly would not be possible. Certainly appreciate their trust in us to be able to deliver performance and service that we told them that they should expect and deserve. So very, very happy about that. Look forward to continuing that. A lot more to talk about as we get into 2025, relating to the results and the service and how that's different than what everybody else is accustomed to in the world that I am operating in here. So very, very proud of that. But yeah, I appreciate you bringing it up. More to share as we get into January. I'm very, very excited to talk about that in some detail. But also wanted to answer some viewer questions. And I know that we got a very interesting question. I'm not sure if it was a person or robot, but still appreciate the question. So feel free to drop them in there, the YouTube channel. For those that follow the program, thank you for your viewership. Those that are new, welcome. This is a podcast for you if you're the type of individual that wants to learn a little bit more about investing, finance, financial planning. But what we try to do is provide a historical spin on all of that information that you're probably getting from Barron's and every single news outlet that's out there. They do a really good job of bringing things to your attention, and they're generally kind of fearful in nature, but there is a very direct reason for that. Media is a business for profit, believe it or not. And in order for them to make a profit, they got to sell ads. So how do they do that? Well, they understand human beings' nature. They feel losses twice as much as they feel good about gains. It's been proven scientifically through the study of behavioral finance, which you can get a PhD in these days. And what we know is that if humans feel losses twice as much as they feel good about a gain, well, the media is going to placate to that fearful emotion more frequently, because you're twice as likely to respond to it, twice as likely to be engaged with it. And that's how they sell their ads. There's nothing wrong with that model. What I don't like about it is there's always a historical precedent, other than the COVID pandemic when they shut down the whole global economy. Other than that, there's always been some sort of precedent, meaning that human beings have dealt with this before. So if we understand how the human being has dealt with whatever it is that there might be a reason to be concerned about, and there always is something in the marketplace, we can say, okay, well, how did other humans handle this over the last 100+ years? And we can then get the probabilities of what the sectors of the S&P typically how they perform under those circumstances. Now you have all the information that you need to first and foremost control your emotions, which is the number one reason Warren Buffett says individual investors don't achieve the results that they're looking for consistently, is they have no control of their temperament. In other words, their emotions when it comes to making investing decisions. That's how we provide our clients with that peace of mind and control over their temperament, by communicating, hey, here's what history has to say about how other humans have dealt with this similar circumstance. Now, for all the compliance people, past performance is not a guarantee of future results, and investing does involve risk, including risk of loss. All this does is control your emotion and puts things in perspective from a probability standpoint. Now you know the risk reward, Now you can start to make your allocation decisions, which is the biggest driver of performance for any individual investor. That's what this show is geared towards, is helping you understand what those probabilities are so you can make better, more consistent decisions. But with that being said, we did get some random questions from crypto audience, and we are crypto fans here. I was not originally. I am open-minded enough to know when I might be wrong and need to reconsider things. And thankfully, we have and benefited greatly from the appreciation of Bitcoin itself, specifically through MicroStrategy, which we've talked about on the show. I'll talk a little bit more about. But we had an interesting question regarding some other crypto, and my esteemed coworker here, Ezra, is not a financial expert.
I
However,
am not.
he has had more experience investing in crypto than I do, because he was in this space well before I was. So, as I know that you know the answer to this question, did a little digging into it as well. So, I want to make sure that we're addressing the question, whether it came from a human or a robot. So,
Yeah,
go ahead
yeah.
and take it away, Ez.
Well, yeah, thank you for teeing me up right there on that. And let's just go ahead and come clean to our viewership as a whole. Yeah, I fell for a bot question totally. That was not a real person. I'm almost positive it was a bot. But we were so excited to get a question that led into kind of some of the more deeper aspects of owning crypto that, in my eagerness to engage with our viewership, I totally did not tell it was probably for some Russian troll farm. So as Joshua said, you got to get those likes, you got to get those clicks. But basically, the question was asking with a really specific type of crypto wallet that could link to crypto wallet that uses USDT. So just you deposit US funds. How do you transfer that over into Binance? Um, and the generic answer for pretty much any transfer ship over to any kind of crypto wallet is that when you go to transfer funds between wallets, you're going to have the option to pick a specific network, and you just want to make sure those line up and that you copy and paste the addresses through those networks very meticulously, and then everything else is handled within your individual apps. So if you want any more specific questions about that, hop into the comment sections on this video and prove that you're not a bot. It actually, maybe don't, because I'll still fall for it. It won't matter. And we're going to have content for the podcast. Um, but as Joshua has been saying, I am not an investing expert. That is purely for Joshua and John to handle. However, I have been involved in crypto for a while. And primarily, though, what I do is buy through a broker firm. So um, that's just kind of my experiences. And I employ some of the strategies that Joshua talks about all the time with that dollar cost averaging and some other things. So it's worked out for me very well. So
Perfect. I appreciate that, Ez. A little bit of a technical question regarding transfership of altcoins. So, appreciate the question. Keep them coming. Don't forget,
yeah,
if this is your first time to the show, hit the like, subscribe button. That way you're notified, whatever,
we're saying notificated from here on out. That's all.
notified every time that we drop one of these on YouTube Live. We try to do them about every 2 weeks, but they got the holidays in here, so this is a little off script. But we did it purposely because not only have we gotten through the election, we've gotten through earnings. We are now getting updated inflation data. So we got some inflation data yesterday. This one I want to kick the show off with here today. Next week on Wednesday, the 18th, in the afternoon at 2:30. Fed Chair Powell will be speaking. The expectation is another 25 basis point rate cut. We are expecting that. The market's expecting that. There's over an 85% probability of a rate cut, and Fed Chair Powell is not one to surprise the market. Therefore, I expect that to happen. So the main takeaway for next week is going to be what he says during the presser when he actually has to answer questions live and not from a script. The tone he sets for that is going to be very, very important as we go into the new year. So we'll try to do a show, I think, next Thursday as well as, and you kind of get the following reaction from us here at Shepherd Wealth Management after that Fed announcement. So with that being said, we did get some macro data here today before I start about 2025 and crypto and everything else that we kind of have teed up for today's program. CPI came out on Wednesday of this week. Came in line. CPI year over year 2.7. That was the expectation. The core CPI year over year came in again as expected, 3.3%. Initial jobless claims was data that we got here this morning at 8:30. That ticked up. So markets were expecting 220,000 initial jobless claims. The previous month was 224,000. So very little difference in change there. The number came in a little higher than that, though. 242,000 initial jobless claims is the number today. Again, that kind of all but guarantees a rate cut here in December. The Fed is more focused, and they've said this very plainly in prior meetings, that they are more focused on the labor side of the mandate now that they see the path of inflation, falling towards that 2% target over time. Now they're definitely keying in on the labor front. With unemployment rate ticking up from 4.1 to 4.2% and initial jobless claims coming up, you can bet your bottom dollar that Jerome Powell is going to be cutting rates next Wednesday. Producer price index, the core PPI, which is the Fed's and favorite gauge is core inflation. That came in a little less than expected, zero point 0.1 versus zero point 0.2. Although the headline producer price index, which is a wholesale measure of inflation, came in a little higher, zero point 0.4 versus zero point 0.2. My guess is they probably rounded up a little bit from that. So I'll dig into the numbers here specifically and maybe have a little bit more detail to share with the audience as far as what parts of the inflation measures actually drove some of the producer price inflation numbers that we're looking at here. So now that we know the core, now that we know the CPI core, we know the PPI core, now we can start to get pretty close to understanding what the Fed's favorite measure of inflation is likely going to look like in their next reading for core PCE. We have about 90% of those data points now, so we'll start to come up with some commentary around what the expectations are for the Fed's favorite measure of inflation. I'm sure Jerome Powell will talk about that on Wednesday of next week as well. Now, markets are taking all this stuff in stride. It's been an awesome November. Been a really good start to December. I think we're in this zone of hesitation. We just got through CPI. Now we got to get through next week's Fed meeting on the 18th. And then after that, I really don't see much of a reason not to expect a Santa Claus rally. Historically, December being one of the better months for investors to participate in the markets. The others being at the beginning of a new year, like what we're getting ready to talk about here for the remainder of this program. And all the data sets for that. So I wanted to start to talk about 2025 a little bit. We do see strong tailwinds supporting stocks in 2025, but we also see this as a tale of two different halves to 2025. Now, our base case as of now, and I think that this is something that's going to have to continue to be adjusted, just like at the beginning of the year, as if you recall, and those that have been viewers, you might remember this. If not, certainly go back and you can check out our work in January of this year as far as expectations for this year. And we were calling for another double-digit year, as you pointed out at the beginning of the show, as a lot of people were not expecting that. So we were right in that sense, but we undershot the performance of the S&P. I'm happy to undershoot and have the S&P over-delivered. That's awesome. But we were price targeting around 53.50, and the S&P crushed through that by March.
Oh, yeah.
So we came back out again, I think, around the summertime and said something to the effect of, I want to say 6,000, maybe 6,100, somewhere in that ballpark, but we're already there, with a few more weeks left for markets to blow past that. And I think that they will, which is why we wrote to customers in a previous newsletter, I want to say in November, maybe October. I'd have to go back and look, but we adjusted that again. We were calling for 6,300 on the S&P before the end of the year, and we'll see what happens. We're not too far away from that right now. It certainly is a number that we think is definitely doable between now and end of year, and we'll be able to talk more about that in January to see what actually happened. But talking about 2025, our base case as of now, and again, I think this is going to be adjusted throughout the year for all the things I'm about to talk about. I think that there's an equal probability that we have another type of year, 20+% next year. It's definitely possible. I'll talk about some of the reasons why we feel that way. But I also think that there's an equal probability in the back half of 2025 that all the changes that this administration is going to try to implement and try to do very, very quickly at the beginning of the year could be great long term. It could be great short term, but it also could cause some headwinds and some uncertainties that could affect markets in the back half of the year. So I think there's almost an equal probability of either of those things happen. We just don't know because the new administration has not stepped into office yet. That won't happen until the 20th, and we just won't really know all there is to know about what they're trying to do and how it'll affect prices and inflation and wages and everything else that is a part of a very diverse economy here. We can't really know. So we're going to have to be willing and open-minded enough to make adjustments going into 2025 and throughout 2025 based on how this administration, moves forward with their agenda and how that ultimately affects corporate America and prices and obviously the stock market. So our base case as of now is that we see the S&P 500 at 7,000 in the first half of 2025, but we actually could see and are anticipating the back half of 2025 being worse, with the S&P actually finishing around 6,600 for the year. So ultimately a positive year if that were to play out, but not a double-digit type of performing year if that is in fact how it plays out. Now, again, I think that there's an equal chance that this is in fact a year, 2025, where we do get another year like what we've just kind of experienced the last couple of years. And there is historical precedent for that. And I'm going to talk about all of these things here in just a second. Now, there are two important factors that I think also need to be in every investor's mind. There are, for sure, there are two puts in the market right now. And what I mean by that is there is a Fed put. So as inflation's easing, the Fed's focusing on supporting employment. As I mentioned at the top of the program, they're more focused on the employment side of their mandate than they are on inflation. Inflation's path, although it can be up and down sometimes, its path overall, looking at it historically and from a long period of time perspective, the path of inflation is still staying and sustaining itself towards 2%. So they're going to continue to support the labor market. That is a put by the Fed. They will cut rates in order to support the labor market. That's how they can do that. As interest rates come down, it becomes more attractive for companies to invest in their employees, in their business, in their R&D. So all of that is a put for the stock market, meaning that as long as the Fed has the labor markets back, so to speak, and inflation's coming down, interest rates can continue to come down, and that is a way of supporting the stock market, of course. And the second put is the Trump put. As this White House administration implements its policies, this should, in our view, boost confidence and potentially increase earnings per share. So if you're doing deregulation, less taxes, that should put a lot of confidence behind the business community. It should increase the appetite for taking on risk assets by investors, retail investors, as well as institutions. So those two puts are very powerful. Now, as a viewer, as a market participant, does that kind of make sense to you? Do you view 25 in a similar fashion, regardless of anybody's politics? I think it's very clear that there are two very powerful puts in the market, one being the Fed, the other being this administration. Your thoughts?
I agree 100%. I mean, I think even if we didn't have an administrative change, as the last election, those would still be the two most important things, which would be Fed direction and then fiscal policy coming in to maintain the job market. So yeah, 100% agree. Those are the things that are on my mind anyway.
Yeah,
Um,
and I think it's obvious. I don't think that's debatable in any way, shape, or form. I mean, we could be proven otherwise with the administration. Like I said, but they ran a campaign and the results came in the way that they did. So I
right.
think that the average retail investor is like, hey, this is what we expect to happen. So if it doesn't happen, there will be some hell to pay. But I think what is obvious that nobody can debate from the first administration, the first Trump presidency, is his scorecard is the stock market. So when the Fed's behind the labor market and the White House is very much looking at the stock market's performance as a way to gauge their own personal performance, that's some pretty powerful stuff right there just to start out with.
Absolutely. Yeah. I mean, it's like you said, it's basically a green light for investors, so.
Yeah, and we'll want to get into some of the historicals here. Now, that is the two puts. All right, I'm going to put that in its own little box. I'm going to set it aside for a second. All right, I'm going to come back to it. It's still there. All right. The tale of two halves thesis. This is more from a historical perspective. Okay. So our base case being first half of the year, awesome. Back half of the year, weak. Ultimately a positive year. But here's the reason why, the probabilities of another 20+% type of year could happen, but also historically might not happen. It has everything to do with history. Okay. And that's again a big part of our program here. It's a big part of how we help clients make decisions or how we make decisions on their behalf and how we communicate the rationale as to why we make some of these decisions. Now, again, I got the two puts in its own little box over here. Let's talk about history. It has its own little box of data. So after back-to-back 20+% year gains in the S&P 500, what is the precedent for that historically? Well, it's happened 5 other times since 1871. That's right. You heard it right. That's well over 150 years worth of information, okay, worth of data. Now, first of all 5 precedents of 20+% gains, over the 4 years, the cumulative average return was 69%, compared to 2021 through 2024, that's 3 years, 27%. Now we have 1 year left. Question is, what's going to happen? Well, 4 of the 5 precedents saw stocks fall the third year. Again, 4 or 5 times where the market's done 20% gains in the third year, stocks fell 4 or 5 times. The only positive instance was 1996. I'll talk about 96 in a second. It was an awesome back half of the year. So again, it could happen. I think the weighting is equal here, given the administration and the Fed put that I talked about previously in this own little box. Then you have this historical box. History says that this third year should start out well, but might not finish well. And we'll get into the numbers here in just a second. It could be one of those other instances where it is actually, in fact, awesome in the back half of the year, which I think is, again, an equal probability for either of these outcomes. Now, here's the one last caveat before we get into the numbers. 5 of the 5 precedents did see stocks do worse in the second half of year 3. Okay, so the question is, how is 2025 going to play out? Because even in 96, the back half was worse than the first half, but it was still freaking awesome, which made the whole year just amazing. Right? We'll talk about those details in just a little bit. So what could go wrong? Well, to us, the downside risks are as follows. And again, we just don't know what the outcome is going to be to this. And I'd love to chat a little bit about this with you, Ez, just kind of get your thoughts on it. So what could go wrong? Well, aside from geopolitical stuff, because the truth is every single year when investors wake up January 1, there's geopolitical risk. They cannot diversify that away. I don't care who's in office, whatever period of time you want to look at. Geopolitical risk has always been a risk and will always be a risk for market participants, period. But what could go wrong to us? Downside risk, in our view, is not inflation. I know that you're seeing people on the news talk about, oh, there's a potential spike in inflation. Inflation can come back and this and that. Well, let me just put it to you simply this way. If this administration follows through on anything the American public said that they wanted them to do, such as energy independence, well, I believe that they're going to follow through on that. They've had a precedent for that in the previous administration. What does that mean? They're increasing supply of things like oil, other commodities, liquefied natural gas, etc. Well, if you increase the supply and demand goes nowhere, the price of that commodity is coming down. With this new administration, they have DOGE, the Department of Government Efficiency, and they're going to be charged with, reducing some of the waste from the federal government. Now, we do know what happens when the price of oil goes down. That certainly is going to affect the stock prices. And if oil stays down throughout this administration's tenure, I have a very difficult time seeing how inflation could reignite, given the impact of oil on every single sector within the S&P 500. Now you have the Department of Government Efficiency. So what could go wrong? They could be too effective. They could do such a good job of reducing government waste that a lot of dollars are not going to be spent in the public marketplace. And that's not necessarily a bad thing. The private sector, private corporations, publicly traded corporations do a much better, more effective at deploying capital than, let's say, the federal government. But there could be a window of time here where all that spending is no longer coming into the marketplace, coming into maybe chip manufacturing. I don't think that'll be the case, but let's just make that assessment here for just a second. Maybe some of those federal dollars for infrastructure don't, actually get spent. They get spent elsewhere because it is more efficient for the U.S. economy, or whatever the case may be as why they would do that. I don't know, and it's too early to know. But this is a risk in the marketplace out there, and we won't know until it actually happens how it's going to play out into the stock market. Now, the other, what could go wrong is tariffs. Now, I think the majority of these tariffs are going to be used as a negotiation tactic. Like we're already seeing that with Canada and Mexico from a border patrol policy perspective. I think that that's the way that they're likely to use the idea of tariffs. But if tariffs are implemented, it actually could affect prices of certain things. It could actually trigger potential trade war with a larger economy like China, as an example. Although from the prior administration, no, none of those things were actually an issue. There wasn't any inflation to speak of during that prior administration. So again, these are things that are out there that they could be risk potentially. They're definitely being talked about in the news right now. So we have to be open-minded enough to say, hey, this could be something to be concerned about. But until we actually see it happen and play out, we're just not going to know. Which again, why I think we're going to have to be, open-minded to both potential outcomes here. It could be another 20-30% type of year next year, or it could be another year where there's a ton of enthusiasm right away, which is the expectation, and then it fades away after some of these things start to get, implemented. Possible. So we have to be open-minded enough for that. And history would support the back half of a second-term Republican president is really good in the first half, but historically not so great in the second half. And coming off of two back-to-back 20% type of years, history says the third year and the back half of it, probably not great. 5 of 5 times it was worse. Even in 96 when it was an awesome, both first and second half wasn't as good. So we'll talk about some of those details here in just a second. Actually, let's just get to them right now while we're talking about it here, Ez. So,
Yeah, sounds good.
yeah, so we're talking about double-digit type of years, and in 1996, in the back half of the year, markets continued to accelerate. Just wasn't as promising as the first half of the year, but we're still talking about double digits in the first half, followed by double digits in the second half. But in 1880, markets fell. 1928, markets fell in the second half. 1936 fell again. 1955, markets fell. And then 2024, as we're going through it right now, the first half has been a little better than the second half as well. So those are the historical numbers there. But if it is like a 1996, 1997, you could be seeing more than a 30% type of year in next year, which is again why we need to be open-minded enough to make adjustments along the way. Now, as we talk about things like earnings expectations for 2025, the way that we see this, since we just got out of Q3 earnings, which was again awesome, we see the 2025 to 2026 earnings per share growth somewhere in the $275 to $300 earnings growth. That implies about a 13%, 9 to 13% year-over-year growth for earnings. We do expect corporate spending to pick up. It did fall over the past few years, but easing of financial conditions as interest rates come down, that's what that means. We do expect corporate America to reaccelerate some of that spend, a lot of that going to artificial intelligence and technology, of course. We do have a potential of GDP recoveries in places like Europe and Asia, given the change in monetary policy stance that they have right now. There is a weaker U.S. dollar, which suggests there is upside to earnings per share for companies that sell their goods and services internationally. And productivity is improving. Again, this artificial intelligence investment is a real thing affecting bottom line profits. Therefore, we kind of expect, or not kind of, we do expect the PE multiple, the price to earnings multiple, to expand in 2025. We expect this to move up from 21 times 2025 earnings today to 22 times earnings for 2026. Now, since 1937, the highest price to earnings ratio realized in the S&P 500 was when Treasury yields were between 3.5% and 5.5%. That is right where we're at right now. We're still in that window. We'll remain in that window for all of next year. We'll see what the Fed does with interest rates, but right now the expectation is about 3 interest rate cuts, with the next one after December being in March. Expectations are the Fed would pause a rate cut in January, let the new administration come in, do their thing, see how that plays out, meet again in March, and we'll see what happens. But they next cut post next Wednesday is expected to be in March at this time. Now, again, the highest price to earnings ratio since 1937 in the S&P 500 was realized between 3.5% and 5.5% yields in the Treasury. That's where we're at. That's where we'll for sure be in that same range by the time we get to the end of next year, unless something dramatic happens with the labor market and the Fed has to, cut rates substantially. Now, when the Treasury yields are between 4 to 5% since 1937, the price to earnings multiple in the S&P 500 has been greater than 18 times, which is again where we're already at right now. So people say the market's expensive. I'll say to that, kinda. The seven largest companies that make up the S&P 500, we all know the names of them. The Mag 7, they have a PE multiple greater than 30. I think they're all justified given the fact that they're the best companies on the planet. And the other 493, the PE multiple is right about 18. Now, again, I expect multiples to expand, and we just covered all the reasons why we would anticipate that. Now, our favorite sector ideas going into 2025, given that you have the Fed put on the labor market, which is great for risk assets like stock as well as Bitcoin. You also have the Trump put. He's looking at the stock market as a scorecard to how well this administration is doing. And you have history suggesting that first half of a second year term of a presidency is really good. Coming off of two back-to-back 20% years, also really good to start that third year, but the back half being potentially not as robust as the first 6 months. So what are our favorite ideas coming into 2025, expecting robust first half of the year? Small caps, we've been in this very heavily all year long. Most recently, as of the beginning of November, this has been the outperforming asset class. Small caps were up 11% in November alone, dominating everything else across the other major averages. I expect that to continue. We've talked about all the historical reasons why that would continue, and you have to go no further than deregulation and lower taxes. Small caps benefit greatly from that. We also love financials. Again, deregulation. This administration, President-elect Trump, has already announced Treasury secretaries, SEC chair people, all of those folks. He just named a gentleman today, I think this morning, is going to replace Lena Khan at the FTC, meaning that there will be open markets for mergers, acquisitions, and IPOs. All of those things benefit financials greatly. All of that deregulation helps industrials greatly, knowing that we need to, fix the grid and have better highway systems and more chip manufacturing here domestically, et cetera. All of that deregulation, lower taxes, benefits industrials substantially. And oh, by the way, small caps, the IWM indexed ETF that tracks the Russell 2000 index, almost 50% of that, really close to 50%. It's like the high four, I want to say about 48, 49% of that index is financials and industrials. They're just smaller financials and small industrial companies. That's another big reason why we like small caps. The last asset class is Bitcoin. We expect Bitcoin to be fantastic performer for 2025 and potentially beyond, given the fact that this administration is running on a pro-crypto policy. The new SEC chairperson is pro-crypto. They're talking about making a reserve, much like the oil reserve that we have here in this country. Talking about adding crypto as another reserve. As I know that that's something that you've talked to me about for a very long time. And it seems now that they have the pieces in place to make this a reality. And I don't necessarily disagree with it. Any thoughts you would add to that?
Yeah, I mean, we've already seen a precedent for it with other foreign countries. Certainly, El Salvador was the first country to adopt Bitcoin as actually a national currency.
Yep.
Um, you see hedge funds. I mean, even when there was the supposed crash of Bitcoin, and it did fall dramatically from the high it had during the pandemic to the beginning of, I think, maybe 2022, where it went down to about 11,000. But you saw
No joke.
hedge funds scooping in and taking
Yeah.
tens of millions of Bitcoins early on. And boy, did they know what they were doing. That was a big sign for
No
me to
kidding.
continue my continued, acquiring of Bitcoin.
Yeah.
And thankfully I did. It certainly has paid off right now. But yeah, I mean, again, this may be like a longer. We talked about this earlier. Maybe having a whole podcast about, crypto and certain things revolving around it coming up in the future, early 2025. I don't think it would be a negative idea totally. The thing is that we've seen some unprecedented volatility with Bitcoin in the past couple of years that makes me give pause
Mhm.
to dumping large amounts of like our country's financial uh what am I saying? Like stash into it, because it can fluctuate. I mean, we've seen in 2 years it go from 11,000 to 101,000, and it can go back the other way too, right? That's the thing with it.
100%. And that's the other side of the equation. So yes, I'm glad you brought that risk up. That is, in fact, the risk. However, when the United States government gets involved into something like this, right, with a crypto czar and AI czar, to address policy, how it should be regulated, who's going to regulate what. If you remove all that uncertainty from a regulatory standpoint, it does a couple things. One, it justifies the reality that this asset class, crypto, isn't going anywhere. That confidence in and of itself is going to drive flows to that asset class. Number two, it opens up the door for institutions. What I mean by that is a lot of mutual funds, as an example, are not allowed to purchase Bitcoin directly. They're not allowed to invest in companies like a MicroStrategy or a Solana or whatever, right? Because of the volatility that Ezra just pointed out of this asset class. Well, if the United States government justifies and has use cases for something like crypto as being a strategic reserve for the Treasury, now you have institutional dollars flowing to something like this. And that is the other half of the market that really cannot participate the way that the retail market can in these types of things. So that can significantly increase the value of something like Bitcoin. Now, our base case, as it relates to this going into 2025 with this new administration, we're going to be paying very close attention to how they go about doing these things. But in our base case, we actually can see Bitcoin hitting $250,000 in 2025. There are two significant tailwinds for Bitcoin. One is there's a halving process that'll play out, and price cycle already favors upside for Bitcoin in 2025. And two is what we just talked about, a friendlier government regulations as this Trump administration embraces Bitcoin. For that, we expect Bitcoin to hit 250,000 in 2025. Now, the path of that does not have to be straight up. To Ezra's point, we can see a significant rise, like we've seen here since the election. I think like a 40% type of move for this asset class. Correct me if I'm wrong, Rez, but I think that's about right. And it can come down just as quickly. To your point, if there's any snags in the way that this administration wants to go about, approaching regulation and all these things that they've campaigned on as relates to things like crypto. But it
I,
brings up a very interesting conversation. But go ahead, Ez.
Sorry to interrupt. I was going to say, yeah, I mean, and the side that I'm kind of worried about um, is if there is regulation of Bitcoin, it stops it from being what it is, Bitcoin. And it could either halt any kind of growth and just keep it as a fixed asset. But regardless of what regulation does do, it's going to turn off, I think, massive amounts of people from investing in it. So I actually think regulation will hurt the value of Bitcoin. If the
Yeah, and
government, that's the whole point of it, is to be something
yeah,
for the people aside from any type of thing like that. But what you're seeing is the participation in the volatility uh, becomes really lucrative for folks that can afford it. So I think that's where the allure is coming from for this kind of the other side of the market, or the other side of the investing sphere, if you will, to want to get involved. But there is a big chance that with the administration's desire to promote Bitcoin, they kill it. I think it's actually greater than them enshrining it and making it something that's like kind of an evergreen asset class. So
possible. I think that the way that I read their language is regulation, removing of regulation. They just making it clear on who's going to regulate, crypto, and what that looks like. So just that in and of itself, hopefully, is a bullish move for that asset class. But if in fact this administration is going to, and as I think the um, Treasury Secretary appointed has already kind of pointed out, is there is a desire to have this as a part of a reserve for something like the United States Treasury, much like we have an oil reserve. And if that were to happen, then you have to look at gold, or I'm sorry, crypto replacing gold, right? Now, if that were to happen, we have to look at the numbers. Well, the gold asset class is worth about 19 trillion, give or take. The Bitcoin is about 2.5 trillion, give or take. So if there's parity in price, well, there's only so much Bitcoin, right?
Only so much
Whereas
gold. Yeah.
there's only so much gold. That's what they say anyway.
That's what they say.
But you can clearly see the market for gold is much larger, right, than crypto.
Oh
So if
yeah, and
there's
as an
only a
aside, we can grow a diamond in a lab in 15 minutes. I'm sure they could pull a gold bar out of something.
it's my point. So let's just say that there is some limit to gold, but we don't really know what that is, right? But we don't really know.
Right.
We do know what the limit is on Bitcoin. That's very plain.
100%.
So if there's a limit on that supply, being Bitcoin, and Bitcoin is now going to potentially replace gold, then the only thing that can happen for parity to take place is the price of Bitcoin would have to catch up with gold. Fair? If that were to happen, given the size of gold as an asset class being about 19 trillion and a limited supply of things like Bitcoin, the price of the coin itself would have to trade right at about $1 million per coin to come to parity with gold. Now, I don't know how long that takes. I'm not calling for that to happen in 2025 at all. And it may never happen, to be very clear. But I do think that it is very possible that something like that could happen for this asset class if this administration is actually able to execute all the things that they're talking about doing. I'm not saying it's going to happen in 4 years either. I think that would be a very difficult thing to take place, although it could be a reality. It's not out of the realm of possibility anyway. But I do think that is a level that Bitcoin could rise to in my lifetime, in our lifetimes.
I
Um,
wouldn't be surprised either if it especially if it gets more. I think if the possibilities of using it as an actual currency globally become a lot more real, like you can go on a trip to Branson, Missouri and pay for Starbucks with your Bitcoin, just like you can with Apple Pay. I think the more that becomes feasible, I think you're right. It could see such a dramatic rise as to be a parody of gold.
yeah. And those are the numbers, folks. I mean, I'm not pulling this, out of left field. These are the numbers. So take all that into consideration. I do think that everyone um, could afford to have 2% of their investable assets in this asset class called crypto. A lot of ways to go about playing it, given your risk tolerance and liquidity needs and things of that nature. But I think this is an asset class that should be considered. I was the very first person when I started Shepherd Wealth Management 3.5 years ago, and we started doing these podcasts. Ezra was already a participant in crypto. I was the most anti-crypto person right behind Warren Buffett, you know, and I just got on camera and talked about all the reasons why. The thing is, Buffett and I were wrong in our view of that asset class. That it's not going away. All right, it'll be around for all of time now. Maybe not all the altcoins and all that sort of stuff, but Bitcoin and crypto will be a thing. There's no question about that in my mind at this point. Now, just like Buffett with Apple, as an example, he didn't always own Apple. Matter of fact, Buffett damn near never invested in technology until he made that very substantial investment in Apple. I want to say it was around 2017 or somewhere in that hemisphere after Apple had already become the Apple that we know it today after selling billions of iPhones and so forth. He invested, and people thought that he was way late to the party, and they were wrong too. Apple's
Yeah.
still charging and climbing just fine, and he made a ton of money on that. So
That
my
just
point of
proves
that,
your point from last episode where it's
yeah,
you can't time the market, but get in and make money.
you cannot time it. What you can do is you can look at how other humans is what make up the market, folks. I don't know if you know that or not, but everybody that's participating in the market is a human. Whether or not it's a computer executing the trade, like an algo, a human being created the algo. They created the parameters on how that thing is going to operate. Okay, market's made up of humans. humans are the most predictable thing on the planet. We haven't changed all that much in a couple thousand years, which is the reason why you need to understand how other human beings have behaved under very similar market circumstances so you can put those probabilities in your favor. That's what we're trying to do here for our customers. And I bring up this story of Buffett and Bitcoin and my views on it 3.5 years ago, because if we were so stubborn to never allow our minds to open up to the possibility that we were wrong on that, Buffett never would have made the money that he made on Apple, and we certainly would not have made the money that we made for our customers in Bitcoin, specifically through the MicroStrategy position that we're holding for them. Which, by the way, Ez, did you catch any of that MicroStrategy stuff on the news when Michael Saylor was out there about a week and a half ago? Any of that?
I did not. No.
Yeah, it was a really cool interview. For those that haven't seen it, I'd highly recommend just going to YouTube and just search Michael Saylor. Anything within the last week and a half. That's what I'm referring to. He's got a very innovative way to go about tackling the investment in Bitcoin specifically. They're essentially issuing debt, a convertible debt note that they can convert from bonds to shares of MicroStrategy and effectively pay zero interest on it because of that option feature, right? If you convert from debt to stock, well, now there's no longer any interest paid, unless you're paying out a dividend as a corporation. So he's effectively able to raise a large amount of cash through issuing these convertible debt notes, pay virtually zero interest on it, and use all that capital to buy Bitcoin. And it is working obviously very, very well. If you pull up a chart of MicroStrategy over the past, several months and even the past, year plus.
Wow.
So it is in fact a leverage play, on Bitcoin. The leverage is coming from those convertible notes. I mean, think about it. If you and I, as can go borrow money from a bank or some financial institution and pay zero on it, and then make a 60% average return, which is what the average return of Bitcoin has been since inception on average. I think going back to 2008, 2009, when it became an asset class at first. I mean, that's a pretty good deal. 0% for 60 on average. I mean, damn, that's a good business model if you can keep it going.
Yeah, I would look at that and seriously consider it, I think.
Yeah, and this is the kind of the thought process behind, if you were to make crypto part of the strategic reserve for the Treasury, I think the U.S. government would approach it in a very similar fashion. I don't know if they'll, certainly won't be able to come up with a convertible note like a publicly traded company can, but it would be a very similar sort of approach. You're using some debt, U.S. Treasuries, raising capital by the asset class, dollar cost average into it, just like they would with oil and the petroleum strategic reserve. Same idea. And if that were to be, in fact, the game plan for this administration, you can see, the price going up. Where it goes to is anybody's guess. That's the difficult part of this. Like, I can look at, Apple, since we've been talking about that as an example. They have a balance sheet, they have income statement, they have software, they have hardware, they have people. You can look at all this stuff and come up with a valuation, right? It's different when you have a finite asset class and there's multiple different uses for it potentially. And now maybe you have some legitimacy coming from the largest, economy on the planet, and the United States government wanting to be an investor or a holder of this asset class. So again, going into next year, anticipate a great start. History says be cautious in the back half of the year, but I believe that there's an equal case to be made that the back half of next year could be amazing, just like 1996 was. I think it's just as probable that it could be terrible. Maybe ultimately the year is positive for the S&P 500 in 2025, but it's very possible, given some of the changes that are out there that are being discussed right now, could negatively impact things like earnings and growth. So we'll have to wait and see. But that's the data. That's why we do this show. That's pretty much everything that I wanted to make sure that we addressed here today on this program. Make sure to catch this next week on Thursday. We'll try to do it around the same time. It'll be the day after the Fed announcement, so we'll have a lot to talk about regarding interest rates and policy and how that may affect things coming into 2025. So look forward to that. discussion with the viewers. And don't forget, if this is a program that you're enjoying and getting a lot out of, we'd love to hear your feedback. You can go and leave a Google review for Shepherd Wealth Management. You know, you can simply just search in Google Shepherd Wealth Management, leave a customer review. We'd certainly love to hear from the audience and how this is helping you. If you have questions, you can leave those questions directly on the YouTube page itself, or you can just simply text me, give me a call, 513 630 2664. Check out shepherdwm.com. You can see that all the content right there on the YouTube page, all that stuff's on the website, how to get a hold of me. And last but not least, when you go to our website, you will find that we are now officially SEC registered. Form CRS is right on our website. We're very proud of that. With that, we are also adding on a couple new services for clients at Shepherd Wealth Management, one of which, very excited to announce that we have private banking access for our customers that are looking for, buying a second home or maybe making an investment. We can negotiate favorable loan rates for them on their behalf, potentially, without even having to sell shares, using your own stocks in taxable accounts or trust accounts as collateral for that type of thing. So we can be very creative in both the lending and the deposit side for our customers. In addition to that, we also have a private equity offering. Soon to be announced, we may be coming out with a Shepherd Wealth Management mutual fund ourselves. So that could be exciting. More to come in 2025 about that. We're having meetings and discussions about that right now. But we actually have access for our customers, both on the accredited side as well as non-accredited access to things like private equity investments. What does that look like? It could be real estate. It could be financing debt. It could be private companies like SpaceX that we can get access to for a certain number of our customers. So truly coming to life a vision that I had 3.5 years ago, providing a family office model of professionals, of CPAs, CFPs like myself, estate planning attorneys, private banking, private equity investment, really available for all customers under one entity, being Shepherd Wealth Management, all coming together. And couldn't be more proud of that accomplishment, being SEC registered, being able to offer these kind of services to our customers, which we know, is not available at every bank, is not available at every sort of financial institution, but it is available here. We're providing all of these services for the average American. Now, you do not have to be a high net worth, 25 plus million type of household to access that family office, which is what you would need, by the way. If you were to go true, family office in New York or LA or Chicago or someplace like that, you're going to have 20 plus $million of assets for that household. We're providing all of those same services for everybody in America that wants to participate in that or have access to it. So I'm damn proud of that. There'll be a lot more to share about that in 2025. And we look forward to competing with the best, the biggest, because we feel like we're the baddest. And with that, I'm looking forward to next week already. Looking forward to 2025. I appreciate all the viewership. I hope you guys have a great rest of your week, and look forward to seeing you next Thursday. Have a great rest.